titled my slides today, Living in Interesting Times. And I guess, well, in the last 4 weeks, we've seen talk of Greece leaving the Eurozone re-emerge. We've seen worries about China. We've seen all sorts of interesting and I guess concerning themes come through in the commodity market. So I'm trying to today to give you some thoughts on where I see us at the moment and I guess what lies ahead. Okay, so I've just got a few questions here that we're going to ask. So in terms of commodities and resources, is the best behind us? Will the Eurozone survive to the Olympics in Rio de Janeiro in 2016? What does the moderation in China's GDP growth mean for the resource sector? Has China's steel and indeed intensity of commodity consumption for all commodities peaked, as some of my clients are now speculating? What challenges do the Australian resource developers face? And then, pending time, I'll skip through some commodity views and take questions. Okay, so just to summarise the outlook, we do see commodity prices remaining historically high for the next 1 to 2 years, but costs are still rising throughout the industry, which will pressure margins. So in terms of thinking about the super cycle, I would characterise the next 2 or 3 or 4 years as more cycle and less super. We do see world GDP slowing to about trend growth this year and next, but our baseline has the Eurozone staying together and Greece and the periphery not leaving. We see the US avoiding recession, but we now see a 1/3 chance that Greece will leave the Eurozone. And I'm sorry to say that if that does happen, all bets are off. The good news is that emerging markets will continue to grow strongly as they have done for 5 or 10 years. We see that story taking another 2 to 3 decades to unwind, and that's positive for all of us here today. So, in a broader perspective, the situation still looks consistent with ongoing commodity demand growth. On the supply side, we still see challenges. None of the factors that have been cited in recent years, such as escalating capital costs, labour shortages, increasing project complexity, deteriorating geology, financing, regulatory, environmental burdens, none of that's changed. And in fact, when I talk to industry, they all tell me that that's getting worse, if anything. So, what does that mean in terms of investors? I guess the outlook for me in terms of margins being pressured going forward is that I would advise a preference to long life, low-cost assets with astute asset managers that understand and can manage their cost base. In terms of our view, we're positive towards copper, iron ore, premium coking coal, oil and LNG, and we're a little bit neutral to negative on aluminium, thermal coal and uranium. Okay, just in terms of a macro outlook, I said before, central case is that the Eurozone doesn't break apart, and we see the US continuing to recover and emerging markets continuing to grow. That's consistent with ongoing good commodity demand growth. You'll see there we have GDP growth globally at 3.5 this year and next, but then into the medium term, world growth picks up to 4.5%, and the reason is that a larger share of world growth is coming from emerging markets, and that's not going to change anytime soon. Right, in terms of the Eurozone and the Grexit, the potential exit of Greece. The chart there shows world trade and IP volumes in these pinky red lines and global interbank spreads, which is a measure of stress in the banking system. And you can see in the GFC, stress was elevated for about a year, then Lehman Brothers collapsed. And all of a sudden, banks globally got very scared and stopped lending to each other and stopped lending to firms, households, everyone. Basically, world trade, industrial production stopped overnight. And that's the concern with the Greek exit. My colleagues at Commonwealth Bank, we talk about this quite a lot. What would a Greek exit mean for the banking system? We think it is very difficult for the Europeans to be able to ring-fence the Greek banks. And so if Greece does exit, it's going to be very tough for the banking system in Europe to digest that. And then that will impact the banks in the US as well. So this is the risk right now. We gauge that at 1/3 probability. That does mean that there's a 66% chance in our view that Greece won't exit and will be able to continue muddling on. But that is the risk. In terms of commodity demand, developing markets, particularly in Asia, will be somewhat removed from this impact, but they won't be completely immune. I want to just put this chart up. The chart shows the percent of countries in default, which I think is the black line, and the percent of countries with inflation, annual inflation above 20% for the last 100 years. What do you do as a sovereign when you've got a debt problem? Well, there's three options. Number one, you can pay the debt back. How do you do that? You cut spending, you raise taxes. That's really difficult politically, and that's what's happening in Europe right now. The Greek election problem is all about people saying, I'm sick and tired of austerity. We need a new solution. And that's happening in France and Germany as well. That's your first option. Secondly, you can default. You can not pay your debts back, and that threatens your creditors. And that's the issue with the stability of the banking system. And the third option, which we think ultimately is most likely to take place, is you inflate your way out. You print money. And that would be positive for commodity prices and particularly gold. So, I want to move on to China now. There's been a lot of talk about China and potential slowing in demand in recent times. I was up in China for 2 weeks in the end of March, and I guess want to reflect some particular insights. So first of all, how important is China? You would all have a good sense of this, but just wanted to put some numbers up there. So China dominates global consumption of early and mid-cycle commodities: iron ore, coking coal, steel. Copper, aluminium, they're probably halfway there in terms of where we would see them getting to at their peak consumption level. Mid and later stage commodities such as zinc, lead, nickel, and energy, they are either halfway there or a lot less in terms of relative to other countries in their development. And that's why we're positive into the medium term in terms of China's consumption. China's investment share of GDP in the green versus incomes per capita along the horizontal against a range of other countries. And they're at record highs. And people say, well, that leads to excess capacity. It leads to all sorts of problems with resource allocation. Wouldn't disagree with that. However, one of the reasons that China's investment share is so high is because their savings out of GDP are even higher. China saves 53% of GDP. That's extraordinary. And that's why there's so much investment, because the return to savings is so low. What's the cost of capital in China? No one knows. You put your money in the bank as a household and you get a negative real return because there's so much saving. And so this is one of the reasons that we think investment share is so high. The important implication comes down to thinking about how does China rebalance its growth. The government needs to convince households to save less. How do you do that? You improve social security, you improve education, you improve healthcare, you increase spending. But they are all programs that will take a long time to play out. And so in thinking about the composition of GDP growth, consumption plus investment plus government spending and plus exports, if your consumption share is going to take a long time to recover and to start driving economic growth, it's not going to happen overnight. Then to get 7.5%, 8.5% GDP growth for the next 3 to 5 years, you need investment to continue contributing. And that's positive for demand for commodities. Rebalancing and China's growth slowing down. China's GDP has averaged about 10-11% growth annually for the last 30 years. The government is now talking about a target growth for the next 5 years, 2011-15, of 7.5%. And people have been saying, this is the end of the world as we know it. I don't agree. This chart here shows annual GDP growth on the vertical axis against incomes per capita on the horizontal axis for a range of countries. So India, Japan, South Korea, Taiwan, the US, and China. China's in the red. And there's history to about here. And then this is our projection to, actually no, it's the IMF's projection to 2020. So China's GDP growth will slow. as it has done for most countries as their average incomes have risen. So what? When we look at what that means for the yearly increment to GDP, that is the amount of additional spending in the economy every year, this is what it looks like. This black line is the increment of GDP in the economy each year. In 2010, China's GDP rose by 1 trillion renminbi, or about 190 or 170 billion US dollars. That's not right. In 2020, under the IMF's assumptions of China's GDP growth slowing, the incremental amount of GDP spending in the economy in that 12-month period will be 1.8 trillion renminbi. Almost double where we are at the moment. And that, to me, sounds like a good environment for commodity demand. In the very short term, there are some, slight issues with the slowing of the cycle. So rewind a year or two, the Chinese government had an inflation and a house price problem. And this was regarded in the Beijing consensus as threatening to the stability of the economy. If the masses can't afford to buy food or they can't afford to buy a house, they get unhappy, and that's how you lose power in China. So the government decided to step on the economy, tighten credit, brought back fiscal spending, all sorts of policies designed to slow things down, and it's worked. Surprise, surprise. Now inflation has cooled. Inflation is now running at average monthly inflation in China has been about 0.1%, 0.2% for the last 11 months. There's no inflation problem in China anymore. And so the government is looking to loosen things up, and they have been. They have cut the amount of capital that banks are required to hold in reserve against loans. They've started to loosen fiscal policy. They announced a 36 billion RMB package of subsidies for consumer durable purchases last Thursday. On the weekend, Uncle Wen came out and said China's policy stance has to shift to a more positive and pro-growth strategy. If ever there's a signal that things are about to pick up in China, that's it. So, what does that mean? Well, China started cutting the bank required reserve ratio late last year and has continued to ease policy since. That normally takes about 6 to 10 months to come through in terms of pushing more activity and more growth. And so we've been advising our clients now all year that we expect China's growth to stabilise around mid-2012, start to pick up in the back half and then into 2013. The added point I want to note is that China's leadership is changing this year. They would normally have the National People's Congress around October, November each year to announce who the new leadership is, including the 9-member Politburo Standing Committee. That's likely to happen, and those new members get sworn in March next year. In 4 of the last 5 leadership transitions, investment to GDP has spiked the year after, as new leaders have come through with pet projects and pushed economic growth. We wouldn't be surprised to see that happen next year. So we are expecting the Chinese growth story to cycle up in the next 6, 12, 18 months. Again, positive commodity demand and pricing. Right, on to the Australian industry. Sorry about the numbers. They're particularly difficult to read, but I understand that you'll get access to the slides after today's conference. What I wanted to point out, that top table there has the average increase in costs of production for the last 10 years for Commonwealth Bank's equities research coverage by commodity. So, for example, that top left number there shows that costs have grown on average by 8% each year in the aluminium industry in this country. The amazing thing is that we look at cost growth, aluminium 8% in the last 10 years, iron ore 18%, copper 11%, coking coal 18%, thermal coal 16%, uranium 14%, oil and gas 11%. Costs are an issue, a big issue. Let's come back to my point at the start. the importance of asset managers that understand how to optimise their operations and manage those costs. Thinking about the current market, where is the cost support? Those numbers are terrible, sorry guys. We look at cost curves for different commodities. And if we look at the 95th percentile, we see right now that spot prices as of yesterday are 62% above 95th percentile costs in coking coal, 57% above for iron ore, 68% above for copper, and 41% above for gold. So those four commodities clearly are still pretty good places to be operating in. At the other end of the spectrum, aluminium. When I was in China in March, I learned that there's 13 million tonnes of new smelter capacity under construction in Xinjiang province, which is the westernmost province. And it's all about cheap power. To put that 13 million tonnes into perspective, China last year produced 16.5 million tonnes of primary aluminium metal. It's a big deal. And it will undermine cost support for aluminium globally for the rest of this decade. We see the market being in excess supply until 2020 at least. And so aluminium spot prices 17% below the 95th percentile cost right now. Thermal coal. Spot prices today are in line with P95 costs. So that gives you an idea of what's guiding our preferences for commodities. Okay, stepping through our thoughts by commodity. So this chart here shows, I can show this a little bit, shows steel production per capita up here and income per capita along the horizontal. This red line here is China, and the green squiggly line is the US, and then South Korea and Japan are somewhere up here. China's steel industry produced about 500 kilos per capita of steel last year. We think that will peak at about 670 kilos per capita in 2023, 38% higher than current levels. So we still see China's steel production growing. The annual rate of growth will slow, but the increment in terms of what that means is important. So for example, we're expecting China's steel production to grow 4.5% this year. That translates through to about 28, 32, 33 million tonnes of new crude steel capacity or production, and that's about 55 to 57 million tonnes of iron ore standardised at 60% Fe. That's one Fortescue Metals in a 12-month period, let alone the rest of the world. So slower growth in China's steel demand, and in fact, this is true across the commodity complex, is still consistent with a very challenging new additional requirement for the industry to meet year in, year out. You don't go and build a Fortescue in 12 months. So, we see iron ore prices trading through around 140 to 160 per tonne in the next 12-month period. Recently, there's been some volatility in markets. You might have seen some press that there have been some cargoes turned back by the Chinese, particularly for Vale. We understand that essentially what's happening there is that Chinese mills who are buying under quarterly contract have been offered spot cargoes at $5, $10 a tonne cheaper. And as happens through time, the mill in China just turns around and walks away. So, yes, that is negative for spot prices, but we don't see it as a sign of a fundamental reversal in the iron ore story and iron ore demand in China. If you look just up here, this little dip in iron ore spot prices last October, November was when we had this problem the last time. I think people were saying that iron ore was going below $100 a tonne. It got to 116 for a day and then rallied pretty strongly back up to 130, 140. And we see significant cost support from China at those levels. We understand marginal cost of iron ore in China is $150 to $160 a tonne. Average cost is $105 to $110, which says that there's significant support in the range of $120 to $130 a tonne. In other words, we'd need to see China's steel output collapse by 150 million tonnes before we could see iron ore prices sustaining numbers below 120 a tonne for any length of time. Coking coal. Supplies recovered strongly after the Queensland floods, but now we've got strikes. As you would have seen, BMA and their workers in all their assets in the Bowen Basin can't agree, and so there have been a number of 7-day strikes this year. More recently, that's now started to put upward pressure on spot prices, which is just up here. That might be a temporary factor, assuming that the workforce agrees with BHP at some point. More generally, though, we see coking coal prices trading in the low 200s a tonne for the next few years before supply grows faster than demand and we see prices revert to long-run averages. Just checking time. Aluminium, as I mentioned, 13 million tonnes of new cheap capacity in Xinjiang. It's quite a story. And certainly in the 2 years I've been talking to smelters and alumina refiners in China, there is no sympathy for the view that UC Rusal, Rio Tinto Alcan, and Alcoa have pushed through time that China will become an importer or a structural importer of aluminium because of scarce energy and high-cost energy. Xinjiang apparently has tens, if not hundreds, of billions of tonnes of thermal coal that is stranded from getting to the seaborne market. You can buy a tonne of thermal coal there today for $16 US versus spot prices on the seaborne market at about $100 US. The Chinese are exploiting this now in a very aggressive fashion. It takes 12 months to build a potline in Xinjiang. It takes Rio Tinto 2 to 3 years. So, unless you've got great assets at the bottom of the cost curve, aluminium will be challenging. Alumina and bauxite. We've seen a lot of talk recently around Indonesia's move to ban bauxite exports. And that's flowed through in terms of China increasing its imports of bauxite in recent times. They've been stockpiling. They're now investing in alumina refineries in Indonesia. And that will be the dominant play in global alumina markets for the rest of the decade. There is a risk, certainly in terms of pricing, that if Indonesia is successful in limiting its bauxite exports, we'll see seaborne volumes and pricing rally. And the same can be said for alumina. But that's a call on compliance. Of the 45 million tonnes of bauxite that was exported from Indonesia last year, and you can compile those numbers from looking at the trade statistics from the recipient countries, Indonesia itself reports total production of 1 million tonnes. Almost the entire industry is illegal. So you've got to ask yourself, how can the government stop exports in that circumstance? But that risk in the next 6-12 months is there. Copper. Lots of talk around unbonded, unofficial stocks of copper in China under the trade finance import, get a letter of credit, use that money to invest in property. Don't lose sight of the bigger picture on copper. As I said before, China's copper intensity is about half that of comparable countries like the US when they peaked. There is a long way to go in terms of China's copper demand story. And the supply side remains tight. The copper market's very sensitive to events like earthquakes in Chile. Declining grades, costs, strikes, all these things we know about. So we're still positive copper into the medium term. We see prices above $3 a pound for the rest of the decade in nominal terms. Just a little bit on current markets. LME inventories have narrowed considerably in recent months. Chinese inventories have gone up. Unbonded warehouse inventories in China are now up to 600,000 tonnes, we hear, from 300,000 tonnes mid-last year. Now the Shanghai to LME price arbitrage has narrowed, and it doesn't make sense to import copper into China. The most recent trade data saw China's copper imports fall, and we wouldn't be surprised to see that happen in coming months, with potential price weakness in the very near term as a result. Nickel is all about, how am I going for time? Nickel's all about stainless steel demand. 2/3 of nickel is used to generate stainless steel, and stainless steel growth in demand is all about developing markets again. One of the interesting things about nickel is the development of nickel in pig iron, in particular the dependence of those producers in China on concentrate flow from the Philippines and Indonesia. Indonesia's new regulations also ban the export of nickel in concentrate. But talking to lawyers and people close to the government in Jakarta, the local nickel in concentrate industry is quite relaxed. They have plans in place to develop nickel refineries. And so over time, we'll see Indonesia's export of nickel in concentrate fall and their export of semi-refined nickel grow. I guess the big question mark for us, though, in terms of the nickel market and the outlook, is the success or otherwise of the new laterite projects. There's around half a dozen big projects that are coming on stream at various phases of development and various timing. The issues are thus: the complexity of these projects is significant and can give rise to large upfront costs and higher risks of cost overruns. No two laterite ore bodies are the same. It's a chemical process, not a metallurgical process. And so we see risks around the ability of these plants to maintain output and produce. And so we're quite sanguine when it comes to thinking about the role of new laterite plants in nickel supply for the next 5 years. We've done some scenarios here, and you'll see in the pack when you have a look at it later on. But if we start stepping on the laterite projects for the next 5 years, you can get to a scenario where the nickel market moves from current excess supply to shortages. We can't forecast that, but that's the risk. Zinc. Demand outlook is positive. Strong GDP correlation. China's 40 to 45% of demand, and it's about transportation in automotive and construction. We see supply as being challenged in the medium term. There are some large closures coming up. That's been well known for some years now. On the positive in terms of pricing, grades continue to fall. New projects are only replacing 10 to 15% of lost production in the medium term. And so we're positive zinc pricing. On the negative, there is a risk that we'll see higher rates of zinc recycling in the medium term. And the one that I struggle to come to grips with is the role of China's artisanal producers. The guys that, when zinc prices get to a certain level, get out in their farms and their local forests and start digging the stuff up and sending it to the local smelter. Lead is also, I guess, positive into the medium term, but we see the supply risks as more balanced than zinc. Again, demand is all about China. 70% of lead demand is about batteries. 80% of battery demand is about transport. So, on the positive for demand, still very, very low vehicle and e-bike penetration in developing countries. But one of the risks, I think, to that demand outlook in terms of the growth of vehicle penetration is we're now seeing lighter cars built in China. You go to Chinese automotive factories and you ask about the aluminium content in their vehicles versus Western average. It's still below aluminium content in Europe and Japan, but it's moving up that curve very quickly. In the West, we're also adopting lighter vehicles as well. When your car is lighter, you don't need as much power and therefore less lead in the battery to drive it. On the supply side, same issues, grade decline. There are some question marks around China's reform of their lead smelter industry because of pollution concerns. And so we might see costs moving higher as they close old current capacity. And you can see our price forecast there on the right. Gold. What a stellar run gold has had in the last 10 years. For us, gold is about structural and cyclical drivers of the US dollar. The US dollar has been cyclical weak recently because of, I guess, the last 4-year recession in the US. That's starting to unwind. We're also seeing the US dollar rally in recent times because of the resurgence of concerns around the Eurozone and the debt crisis there. But the US dollar also faces structural weakness as well. And that chart on the right there illustrates this. These bars are US government gross debt since 1981. This is 2006, this is the GFC, and this is what's happening with US government gross debt. That's the IMF's projection. The US government's own Congressional Budget Office makes the same projection. US government gross debt will be above $20 trillion in 2017. And the numbers just keep on growing. And that's a political issue. It's the politics. How do you change the politics? You need grassroots reform to come through, as we've just heard from the previous speaker. So, more recently, gold has traded in the last 6 years with a very strong negative correlation with real US long yields. That's this chart here, inflation-adjusted yields. In the last 6 months, though, gold's traded more in line with the US dollar than that yield trade. Does that mean that gold prices might reverse and start increasing again in the next little while? Hard to say. I think it comes down to your view on Greece and what investors will do. We've seen a lot of selling of gold recently as investors have been liquidating other positions and looking for cash and liquidity. And that's likely to continue as long as the euro crisis continues. The other important change recently is the role of the official sector, central banks. For most of the last 2 decades, central banks were net sellers of gold. That's switched to being net buyers of gold. The size of the switch is significant. They were averaging 400 to 500 tonnes of net sales of gold every year. Now they're buying 400 to 500 tonnes of gold. It's a 1,000-tonne switch in a market that annually has 4,000 tonnes of supply available. It's a big deal. And we don't see that unwinding anytime soon. The central banks in Asia are all diversifying their reserves away from US treasuries and US dollar assets. China alone has over $1 trillion of US government paper in foreign exchange reserves and about $40 billion of gold. Silver. Silver demand is about fabrication, and we've seen that grow very strongly in recent times. And most of supply comes from mines, but a lot of that comes from byproducts of polymetallic deposits, and so the outlook for copper, lead, zinc, and other gold is very important in terms of silver supply. And so in terms of pricing outlook, we do see silver prices coming off. There was a lot of punter froth in the silver price early this year and late last year. We saw silver rally very strongly relative to the gold price. That chart on the left there shows the gold to silver price ratio for the last 35 years. That average ratio is about 60 times, and that ratio now is about 50 times. And so we do still see silver as being a little bit frothy and subject to the demand for safe haven assets. And lastly, I'll talk about oil. So US West Texas Intermediate has traded at a discount to UK Brent oil for most of the last year and a half. And that's really because of two factors. One is geopolitical tension in the Middle East and North Africa, and the second is the very strong growth in liquids production in the US that we just heard about. The latter of those two stories is about infrastructure bottlenecks. It's about the fact that it was very difficult to get onshore shale liquids to the Gulf Coast and then onto a ship and into the North Atlantic. That's now changing. As of last week, the Seaway pipeline has reversed and is now pumping from Cushing in Oklahoma to the Louisiana Gulf Coast. And there are more projects like that. As that infrastructure responds, we expect that Brent to WTI premium to close. Fundamentally, demand remains weak in the US. Stocks are at record highs, as that chart on the right shows. EU demand is weak in line with their economy. And again, it's all about emerging markets in terms of that demand growth. And that won't go away anytime soon, particularly in oil. And here's a chart here that will show that when we look at what's happening in the unconventional producing areas of the US, the fact that oil prices have been very, very high as a ratio to the gas price has encouraged a lot of US onshore oil producers to invest in drilling rigs in oil-rich shale plays and stop investing in gas-rich shale plays. And that's part of the reason that domestic supply in the US has grown so strongly. But the problem with that is that these liquids-rich shale plays typically have 30 to 40% byproduct gas. ExxonMobil has said they will continue pumping in shale plays in the US until gas gets to 75 cents per MMBTU. Yesterday it was $2.50. So the outlook for gas costs and supply in the US is very positive if you're a consumer of gas. Perhaps not so positive if you're a producer of gas. So, I'm going to wrap it up now. Just to recap, is the best behind us? Well, I suspect in terms of the super cycle, perhaps yes. We are likely to see the next 2-3 years more about cycle. But again, it comes back to the quality of your assets and your operators that understand those assets. Will the Eurozone survive? Who knows? Unfortunately, the consequences, if they don't, are quite severe. How does China's GDP moderation mean for, or what does it mean for resources? Growth continues. The resources industry will continue to struggle to meet China's year-on-year growth in demand for commodities, which is positive for pricing. Has China's steel intensity peaked? No. Growth has peaked, but the amount of steel consumption has not peaked, nor has it peaked for any other commodity we can find. And what challenges face Australian resource operators? Well, there are myriad, but I've summed it up: cost, cost, and cost. It's all about managing those assets and being aware of your margins. And with that, I'll leave it there. Thank you very much.
Please take Lachlan Shaw for that presentation.
Good.
Thank you very much.
Yeah, good.